As stocks have had a massive rally from those April lows, almost a historic and unprecedented one, with the S&P about 3% from its all-time highs. But could a weakening economy, alongside the risks we were just discussing, derail that rally? So far this week, the data's been a little bit weaker. We had worse than expected claims this morning. ISM Services yesterday was the weakest print in a year. And in the Beige Book, they flat out describe all districts reporting elevated levels of economic and policy uncertainty, along with a bit of a broad slowdown. Nadia Lovell is senior U.S. equity strategist at UBS. And Nadia, do you think that, it's weird. It's like right now that's helping lower bond yields and maybe supporting equities. But do you expect the economy to weaken further in a much more serious way from here?
We do expect further weakness. I wouldn't say serious weakness. I mean, we're looking for GDP growth of 1.5% for this year. And now, as we know, the soft data has been weak, but the hard data has been holding in there. And so we'll be watching very closely for payrolls tomorrow. As you noted, ADP came in below expectations. Some of the survey data and ISM suggests that there could be weakness in employment ahead, but we hasn't shown up in payrolls yet. We'll see what payrolls produces tomorrow. If you get a payroll number in the low 100,000 or something below that, that could give the market a bit of a pause. But at the same time, the market has behaved very strangely around payroll numbers, because you could see some positioning to suggest that maybe the Fed accelerates rate cuts, and you could see a pre-trade of some cyclical areas of the market. So it remains to be seen what the reaction will be, but we'll be watching very closely.
No, for sure. And you say, and this kind of is what we were just discussing, but that the tariff policy de-escalation happened even faster than you initially expected.
Absolutely, it has. But, as noted, we're not out of the woods on tariffs. I mean, we're also watching very closely the legal challenges on tariffs and whether that takes away the president's negotiating powers. But as we know, there are other avenues that the president can take to enact its tariff agenda outside of IEEPA. We're closely watching Section 232 on the sectorial tariffs. We could see an acceleration of that. We know right now, there are 5 critical areas that they're looking at: semis, pharma, copper, and the likes. I think most people are expecting 25% tariffs on that. So that could be an incremental 4 percentage points on the tariff rate. But again, the president did lift that on steel and aluminum to 50%. So who knows exactly where those tariffs might end up.
Yeah, and you've got 6,000 as your base case for the S&P, upside 6,700, downside 4,500. Very similar to the discussion we had yesterday, kind of about what's going on with equities. But I find it interesting that the area you have most conviction really across the board is on the AI theme. And it's right there in front of our face, and we can quibble about NVIDIA's valuation and whomever else you want to call out from the supply chain. But you guys think this is the secular winner and stick with it.
I think so. I mean, and we saw that coming out of the earnings season. And just watching news flow, Kelly, the last few weeks, the amount of announcement that has been made on the sovereign side in terms of sovereign picking up investments in AI, whether it's Saudi Arabia, Qatar, UK, India, and the likes. And that actually prompted us to lift our expectations for AI revenues across the value chain. I mean, we're now looking for $2.6 trillion in revenues by the time we get to 2030. And when you think about that from a growth rate standpoint, it's an over 40% CAGR off of 2024 numbers. So we think that there's tremendous opportunity across the stack, particularly in the enabling layer as well as the application layer. So semis as well as some of those software companies.